Hi, my name is Anna Hess, your Patton University course instructor. Today we are doing Unit 7, Businesses and Consumers in the Financial Market. Let's start with the introduction. It's no secret that businesses need money to fund their operations. However, how they get that funding can seem like a mystery, especially in the beginning. Indeed, this is something many people who want to start a business have to contend with. How do you get the money to start? Fortunately, there are several financing options that carry different advantages and disadvantages, with some being more appropriate for some businesses than others. Businesses aiming to become large corporations may even opt to get involved with the stock exchange or the over-the-counter market in order to generate a large amount of funds. How businesses choose to invest their resources and generate funds can have a large impact on the financial sector as a whole, as it represents money coming in and out of the system. It may be obvious that businesses contribute to the overall economy, but what about households, individuals, and families? Consumers are actually a huge part of the financial system. One of the main ways in which individuals contribute to the financial system is through home mortgages. For many people, a home will be the largest purchase they make in their lifetime. So it makes sense that mortgages represent a large part of consumer contributions to the economy, and similarly that changes to mortgages will have a large effect that will be felt globally. Okay, for Objective 1, we're starting on page 205. Investing in stocks for the long run. Stocks appear to be risky, yet many people hold a substantial proportion of their wealth in the form of stock. We can reconcile our perception of risk with observed behavior in two ways. Either stocks are not that risky, or people are not that adverse to the risk, and so do not require a large risk premium to hold stocks. Which of these explanations is more plausible? To get a sense of the risk in holding stock, we can look at the one-year return on the S&P 500 index for each of the past 145 years. The orange line in figure 8.2 plots the one-year real return to holding this portfolio, including dividend payments and adjusted for inflation using the Consumer Price Index. The one-year real returns show in Federal 8.2 averaged about 8% per year. From a different perspective, the annualized real return on $1 invested in stocks in 1871 and held until 2016 was somewhat lower, almost 6.5%. In looking at the figure, remember to check the axis labels. Start by noting that the scale on the vertical axis goes from negative 40% to positive 60%, a huge range. The minimum return was nearly negative 40% in 1932, and the maximum was more than 50% in 1936. Over the past 50 years, the range has narrowed somewhat to a maximum annual return of 31% in 1996, and a minimum of negative 35% in 2008. Nearly half the time the return on holding stocks has been either less than zero, negative, or above 25%, substantially positive. The graph certainly gives the impression that price fluctuates wildly, and holding stocks is extremely risky. Your financial world. Should you own stocks? Should you own stocks? The answer is yes, especially if you are young. Many people shy away from stocks and invest in bonds or other interest-bearing assets. But remember that bonds are risky too. Even U.S. Treasury bonds carry interest rate risk and inflation risk. Though stocks may look risky, history suggests that a well-diversified portfolio of stocks held over the long term is not. The real question is how to buy stock. There are 5 issues to think about when buying stock: affordability, liquidity, diversification, management, and cost. Prepackaged portfolios called mutual funds address all these issues in one way or another. The problem is that there are literally thousands of mutual funds. So how do we choose? Here are some points to keep in mind. 1. Affordability. Most mutual funds allow a small initial investment. You can start with as little as $1,000. 2. Liquidity. In an emergency, you may need to withdraw resources quickly. Make sure you can withdraw your investment easily if you need to. 3. Diversification. The vast majority of mutual funds are much more diversified than any individual portfolio of stocks. Even so, it is important to check before you buy. 4. Management. Mutual funds offer the advantage of professional management. You do need to be careful, as funds in which people make the decisions, so-called managed funds, tend to perform worse than index funds, which are designed to mimic stock market indexes like the S&P 500. And 5. Cost. Mutual fund managers charge fees for their service. The fees for managed fund runs about 0.8% per year, compared to 0.2% for index funds. This is a significant difference. Over 20 years, an investment of $10,000 with an average annual return of 5% will amount to $26,533. If you pay an additional 0.6% fee so that the return averages 4.4%, the value of the investment drops to $23,660 or $2,873 less. Taken together, these considerations persuade many people to invest in index funds. Index funds are affordable and liquid. They offer excellent diversification, and they tend to be cheap. Don't take our word for it. Always ask before you invest. In 1994, though, Professor Jeremy Siegel of the University of Pennsylvania's Wharton School published a book titled Stocks for the Long Run, in which he suggested that investing in stocks is risky only if you hold them for a short time. If you buy stocks and hold them for long enough, they really are not very risky. To see Professor Siegel's point, we can again look at figure 8.2, this time to see the return to holding stocks for 25 years instead of 1. The green line shows the average annual return from investing in the S&P 500 for a 25-year period versus the 1-year return shown by the orange line. We can see immediately that the green line is much smoother and fluctuates over a much smaller range, and it never dips below 0. In fact, the minimum average annual inflation-adjusted return over 25 years was 2.5%, while the maximum was 11.2%. Siegel's point is that if you buy stocks and hold them for the long run, 25 years or so, past patterns indicate that your investment is not very risky. That was not the end of Professor Siegel's analysis. His next step was to compare the returns from holding bonds with those from holding stocks. The results were startling. Siegel reported that between 1871 and 1992, there were no 30-year period when bonds outperformed stocks. In other words, when held for the long term, stocks are less risky than bonds. For many people, investing in stock is a way of saving for retirement, so their investment horizon is very long. Professor Siegel's calculation tells us that our retirement savings should be invested in stock, and that we shouldn't worry about year-to-year fluctuations in their value. The stock market's role in the economy. The stock market plays a crucial role in every modern capitalist economy. The prices determined there tell us the market values of companies, which guides the allocation of resources. Firms with high stock market values are the one investors prize, so they have an easier time garnering their resources they need to grow. In contrast, firms whose stock value is low have difficulty financing their operations. So long as stock prices accurately reflect fundamental values, this resource allocation mechanism works well. The signals are accurate and investment resources flow to their most social beneficial uses. But at times, stock prices deviate significantly from the fundamentals and move in ways that are difficult to attribute to changes in the real interest rate, the risk premium, or the growth rate of future dividends. While many economists believe that markets are reasonably efficient and that prices reflect fundamental values, it is worth entertaining the possibility that shifts in investor psychology may distort prices. The fact is, both euphoria and depression are contagious, so when investors become unjustifiably exuberant about markets' future prospects, prices rise regardless of the fundamentals. Such mass enthusiasm creates bubbles, persistent and expanding gaps between actual stock prices and those warranted by the fundamentals. These bubbles inevitably burst, creating crashes. This phenomenon is one explanation for the very jagged pattern in annual stock returns, the large gains followed by equally large losses, shown in figure 8.2. You're going to want to finish this reading on your own. After the reading, there's an external page called Tips for Investing in Stocks, then another external page called What's So Bad About Cheap Oil. Lastly, there's flashcards to review. This concludes Objective 1. Objective 2 is starting on page 189 with Chapter 8, Stocks, Stock Markets, and Market Efficiency. Stocks play a prominent role in our financial and economic lives. For individuals, they provide a key instrument for holding personal wealth as well as a way to diversify, spreading and reducing the risks that we face. Importantly, diversifiable risks are risks that are more likely to be taken. By giving individuals a way to transfer risk, stocks supply a type of insurance enhancing our ability to take risk. For companies, there are one of several ways to obtaining financing. Beyond that, though, stocks and stock markets are a central line between the financial world and the real economy. Stock prices are fundamental to the functioning of a market-based economy. They tell us the value of the companies that issued the stocks, and like all other prices, they allocate scarce investment resources. The firms deemed the most valuable in the marketplace for stocks are the ones that will be able to obtain financing for growth. When resources flow to their most valued ones, the economy operates more efficiently. Mention of the stock market provokes an emotional reaction in many people. They see it as a place where fortunes are easily made or lost, and they recoil at its unfathomable booms and busts. During one infamous week in October 1929, the New York Stock Exchange lost more than 25% of its value, an event that marked the beginning of the Great Depression. In October 1987, prices fell nearly 30% in 1 week, including a record decline of 20% in a single day. Crashes of this magnitude have become part of the stock market's folklore, creating the popular impression that stocks are very risky. In the 1990s, stock prices increased nearly fivefold, and Americans forgot about the Black Octobers. By the end of the decade, many people had come to see stocks as almost a sure thing. You could not afford to own them. In 1998, nearly half of all U.S. households owned some stock, either directly or indirectly, through mutual funds and managed retirement accounts. When the market's inexorable rise finally ended, the ensuing deadline seemed more like a slowly deflating balloon than a crash. From early 2000 to the week following the terrorist attacks of September 11, 2001, the stock prices of the United States' biggest companies, as measured by the Dow Jones Industrial Average, fell more than 30%. While many stocks recovered much of their loss fairly quickly, a large number did not. During the same period, the NASDAQ Composite Index fell 70%, from 5,000 to 1,500. It remained below the peak until 2015 because the NASDAQ tracked smaller, newer, more technology-oriented companies. Many observers dubbed this episode the Internet Bubble. The plunge of the U.S. stock market in the recent financial crisis was much broader and greater, roughly halving the market value by early 2009 from its 2007 peak of about $26 trillion. After accounting for inflation, it recaptured this peak only in 2014. Yet, contrary to popular mythology, stock prices do tend to rise, even after adjusting for inflation, over the long term, collapsing only on those infrequent occasions when normal market mechanisms are out of alignment. For most people, the experience of losing or gaining wealth suddenly is more memorable than the experience of making it gradually. By being preoccupied with the potential short-term losses associated with crashes, we lose sight of the gains we could realize if we took a long-term view. The goal of this chapter is to try to make sense of the stock market, to show what fluctuations in stock value mean for the individuals and for the economy as a whole, and look at critical connection between the financial systems and the real economy. We will also explain how it is that things sometimes go awry, resulting in bubbles and crashes. First, however, we need to define the basics: what stocks are, how they originated, and how they are valued. The essential characteristics of common stock. Stocks, also known as common stock or equity, are shares in a firm's ownership. A firm that issues stock sells part of itself, so that the buyer becomes a part owner. Stocks, as we know them, first appeared in the 16th century. They were created to raise funds for global exploration. Means had to be found to finance the dangerous voyages of explorers such as Sir Francis Drake, Henry Hudson, and Vasco da Gama. Aside from kings and queens, no one was wealthy enough to finance these risky ventures alone. The solution was to spread the risk through joint stock companies, organizations that issued stock and used the proceeds to finance several expeditions at once. In exchange for investing, stockholders received a share of the company's profits. These early stocks had two important characteristics that we take for granted today. First, the shares were issued in small denominations, allowing investors to buy as little or as much of the company as they wanted. And second, the shares were transferable, meaning that an owner could sell them to someone else. Today, the vast majority of large companies issue stock that investors buy and sell regularly. The shares normally are quite numerous, each one representing only a small fraction of a company's total value. The large number and small size of individual shares, prices are usually below $100 per share, make the purchase and sale of stocks relatively easy. Until recently, all stock owners received a certificate from the issuing company. Figure 8.1 on the left shows the first stock certificate issued by the Ford Motor Company in 1903 to Henry Ford. The right-hand side of the figure shows a more recent stock certificate issued by the World Wrestling Federation, WWF, renamed World Wrestling Enterprises, WWE. The WWE is the media and entertainment company that produces the wrestling events involving characters like The Rock and Hulk Hogan. The former governor of Minnesota, Jesse Ventura, worked for the WWF before entering politics. Today, most stockholders are no longer receiving certificates. The odds are that you will never see one. Instead, the information they bear is computerized, and shares are registered in the names of brokerage firms that hold them on investors' behalf. This procedure is safer because computerized certificates can't be stolen. It also makes the process of selling shares much easier. The ownership of common stock conveys a number of rights. First and most importantly, a stockholder is entitled to participate in the profits of the enterprise. Importantly, however, the stockholder is merely a residual claimant. If the company runs into financial trouble, only after all other creditors have been paid what they are owed will the stockholder receive what is left, if anything. Stockholders get the leftovers. To understand what being the residual claimant means, let's look at the case of software manufacturer. The company needs a number of things to make it run. The list might include rented office space, computers, programmers, and some cash balances for day-to-day operations. These are the inputs into the production of a company's software output. If we took a snapshot of the company's finances on a given day, we would see that the firm owes payments to a large number of people, including the owner of the office space it rents, the programmers who work for it, the supplier of its computers, and the bondholders and bankers who have lent the firm's resources. The company uses the revenue from selling its software to pay these people. After everyone has been paid, the stockholders get the rest of the revenue. In some years, the company does well and there are funds left over, so the stockholders do well. But when the firm does poorly, the stockholders may get nothing. If the firm performs really poorly, failing to sell enough software to cover its obligations, it can go bankrupt and cease operating entirely. In that case, the stockholders lose their entire investment. The possibility of bankruptcy brings up an interesting question. What happens if a company's revenue is insufficient to cover the obligations to non-stockholders? What if its revenue is too small to pay the landlord, the programmers, the supplier of the computers, and the bondholders and other lenders? It would appear that the stockholders' promised participation in the firm's profit would yield a liability rather than a payment. If the company does very poorly, will the stockholders have to pay the firm's creditors? Okay, you're going to want to finish this reading on your own. After the reading, there's an external page called Using the NYSE Summation Index as a Trading Guidepost. Then there's an external page called How to Use S&P 500 Futures to Predict Market Movement. Then there's a reading called Discussion. Hello, shareholders. Lastly, there's an activity of flashcards to review. This concludes Objective 2. For Objective 3, we're starting on page 653 with Chapter 23, Modern Monetary Policies and the Challenges Facing Central Bankers. As we saw earlier, the financial crisis of 2007 to 2009 and the recession it triggered were by far the most widespread and costly since the Great Depression. And although the financial disruptions began in the United States, they spread to almost all corners of the global economy. Indeed, the peak to trough decline of GDP was greater in many countries than in the United States. See Panel A of Figure 23.1. The subsequent crisis in the euro area triggered even larger economic losses in Greece, Ireland, Italy, Portugal, and Spain. The response of monetary policymakers was likewise unprecedented. Interbank lending rates, the target of central banking policy, plunged in the United States, Japan, and much of Europe. See Panel B of Figure 23.1. And many central banks deployed unconventional monetary policy tools, including forward guidance, fragility of financial markets, quantitative easing, and targeted asset purchases to compensate for the collapse of intermediation and the fragility of financial markets. Although monetary policies failed to prevent the global crisis, they nevertheless helped contain it. Around mid-2009, the worldwide plunge in GDP bottomed out, and most economies began growing again. Some, like China's, had regained strength even earlier, partly because of an extraordinary fiscal expansion. Similarly, the threat of an imminent breakup of the euro area receded in the latter half of 2012, following the ECB's extraordinary interventions. See Chapter 16. Yet, many observers worried that the aftermath of these financial crises would dim the economic outlook for years to come. Some of the concerns stemmed from the deterioration of fiscal conditions. A number of countries racked up record fiscal deficits and surges in government debt in reaction to the crisis. But the damage to the global financial system posed at least as big and persuasive a problem. Deep, long recessions are frequently followed by unusually sharp and long-lived economic rebounds. But the experience of previous financial crises, especially the Great Depression and the 1990s breakdown in Japan, led policymakers to worry that the rebound from the crisis of 2007 to 2009 would be weaker than the norm. They expected that anxious banks would make credit expensive and difficult to obtain, that investors would be cautious about buying securitized assets, and that U.S. householders would prefer to save money and borrow less. Policymakers also made clear that a period of increased regulation and prolonged fiscal repair lay ahead, which added to the hesitancy among intermediaries. The aggregate demand and supply framework described in Chapter 21 helps us understand many sources of inflation and fluctuation in the business cycle, as well as how stabilization policy works. But it does not explain why policymakers in many countries doubted the conventional monetary policy would be sufficient to counter the crises of 2007-2009. And it does not explain the weakness of the recoveries following the financial crisis. To understand these concerns, we must return to the question of how monetary policy affects the economy. Chapter 17 described how central banks influence the economy by controlling their balance sheet. Chapter 18 described how, in normal times, monetary policymakers use their balance sheet to control the interest rate banks charge each other for overnight loans. We learned that the real interest rate is the nominal interest rate minus the rate of expected inflation. Because the expected rate of inflation generally changes only slowly in low and moderate inflation economies, changing the target for the policy interest rate also changes the short-run real interest rate. In Chapter 21, we saw that the components of aggregate expenditure are sensitive to the real interest rate. So by changing the real interest rate, policymakers can influence real economic activity. Yet, the 2007-2009 experience, as well as that of Japan in the 1990s, suggests that conventional interest rate policy does not always work. Even lowering their policy rates below zero, as the Bank of Japan, the ECB, and several smaller central banks did, has not prompted a strong expansion in these economies. To see why not, we need to look at all the ways that monetary policy actions affect real economic activities. That is, all the channels through which monetary policy is transmitted. Examining the transmission mechanism of monetary policy is the first of this chapter's two main topics. The second topic is the question of why, in the aftermath of financial crises, like the 2007 to 2009 episode, monetary policy and the challenges facing central bankers are especially difficult. Monetary policy transmission mechanism. Anytime the central bank alters the size of its balance sheet, the effects ripple through the economy, changing nearly everyone's behavior. Households adjust their spending on houses and cars. Companies rethink their decisions about how much and how fast to grow. Exchange rates change, bond and stock prices move, and banks adjust their balance sheet. In fact, we would be challenged to find a financial or economic decision that is unaffected. To fully appreciate how conventional monetary policy works, then we need to examine the various ways in which changes in the policy-controlled interests influence the quantity of aggregate output demanded in the economy as a whole. These are referred to collectively as the channels of the monetary policy transmission mechanism. We will begin with the traditional interest rate and exchange rate channels. Next, we will study the role of banks, and finally, the importance of stock price and movements. Traditional channels, interest rates, and exchange rates. Central banks, such as the Federal Reserve, the European Central Bank, and the Bank of Japan, target a very short-term, usually overnight, interest rate. In the Fed's case, for example, a change of conventional policy is a change in the target range for the federal funds rate. As we saw in Chapter 21, a change in the central bank's policy interest rate represents a change in the real interest rate, which has a direct effect on total spending. The lower the real interest rate, the higher investment, consumption, and net exports will be. Let's review this process. As the real interest rate falls, financing becomes less expensive, so firms become more likely to undertake investment projects, and families more likely to purchase new cars. Changes in the real interest rate also affect the exchange rate. When the real interest rate falls, investors' demand for U.S. assets falls with it, lowering the demand and increasing the supply of dollars, reducing the dollar's value. See Chapter 19, Figure 19.2. That is, an easing of monetary policy, by which we mean a decrease in the target nominal interest rate, which lowers the real interest rate, leads to a depreciation of the dollar. A less valuable dollar, in turn, drives up the cost of imported goods and services, reducing imports from abroad. At the same time, however, the lower value of the dollar makes U.S. goods and services cheaper to foreigners, so they will buy more of them. Together, lower imports and higher exports mean higher net exports, or an increase in total spending. Okay, finish this reading on your own. And after finishing the reading, there's a video called Introduction to Mortgage Loans. Then there's another reading called What's an Acceptable Level of Mortgage Default? And then there's an external page called More or Less Natural Hazard Risk Than Average. It's all about location. Lastly, there's some flashcards to review. And this concludes Objective 3. Okay, we're starting Objective 4 on page 664. Applying the concept. Debt, the Great Recession, and the Awful Recovery. Was a high level of household debt a major cause of the Great Recession, which began in 2007, and the weak recovery, which started in 2009? If so, would reforming debt contracts make the economy less prone to severe disruptions? Cycles make it difficult to distinguish cause and effect. Did rising debt boost house prices, or was it the other way around? And what was the relationship between the fall in house prices and the decline in household spending and employment? House of Debt. An important recent book shows that 1. A dramatic easing of credit standards for low-quality borrowers fed the U.S. mortgage boom in the years leading up to the Great Recession. 2. The mortgage boom was a major force driving up U.S. housing prices. And 3. The burden of high mortgage debt among those with lower incomes drove down consumption as house prices sank, contributing to the loss of jobs. The book shows that housing prices rose more sharply in zip codes where less qualified borrowers with lower incomes and wealth were relatively numerous and gained access to mortgage credit. Beginning as early as 2005, residents in these same zip codes then cut their consumption on cars and other durable goods by the most as house prices increases began to slow and then reverse. Having risen the most, house prices in those places also fell the furthest when the nationwide bubble burst, as workers who provided services nearby were the most likely to lose their job. In other words, an extraordinary credit expansion stoked the housing boom, especially among families with lower incomes, and the cooling of the boom drove down consumption more sharply than in a normal recession, exacerbating the bust that was the Great Recession. These facts do not diminish the critical role of intermediation in the 2007-2009 crises, which turned vicious only after the September 2008 failure of Lehman Brothers. But high levels of household debt, which led to foreclosure and bankruptcy, made things worse than they otherwise would have been. and securitization of many of the mortgages made it nearly impossible for lenders and borrowers to agree on what might have been mutually beneficial write-downs. This has led some economists to propose new mortgages that shift part of the risk of house price declines to lenders and away from borrowers. Instead of merely being lenders, the suppliers of funds would become part owners of the collateral. In exchange, they would receive a portion of the increased value of the house when it's sold. We now know that a boom in conventional mortgages can lead to a housing bust and debt burdens that generate and prolong a deep recession. But we still need to know much more about the relationship between debt and this business cycle. That would help us understand whether changing the form of debt contracts can help further stabilize the economy. Financial conditions matter in economic upturns too. When central banks hike rates to slow an economy, their success will depend on whether financial conditions respond. If an asset price bubble is underway, as it was in the United States in 2004 to 2006, the economic impact of central bank policy tightening probably will be smaller than usual. As a result, central banks must always take into account the workings of the monetary policy transmission mechanism in order to achieve their goals of economic and price stability. The challenges modern monetary policymakers face. The financial crisis of 2007 to 2009 was a game changer for the practitioners and theorists of monetary policy. Surely no one assumes that monetary policy is a hard and fast science, that a few equations coupled with some statistical analysis and the help of a big computer will suffice. To do their job well, central bankers need a detailed understanding of how both the financial system and the real economy will react to their policy changes. That job would be tough enough in a world that is standing still, but the dynamism that is such a pervasive and desirable feature of today's economy makes the job all the more difficult. In fact, modern monetary policymakers face a series of daunting challenges. In this section, we will look at three that grew more prominent thanks to the financial crisis of 2007 to 2009. First, stock prices and property values have a tendency to go through boom and bust cycles. Second, policymakers' options are limited, as we have seen by the fact that the nominal interest rate cannot fall below the effective lower bound, somewhat below zero. Third, the structures of the economy and the financial system are constantly evolving, and the latter may be affected greatly by changing regulation in the years ahead. Booms and busts in property and equity prices. Nearly everyone agrees that we would all be better off without skyrocketing increases in property and stock prices, followed by sudden collapses. The unprecedented surge and collapse in U.S. housing prices was the ultimate source of the financial crisis of 2007 to 2009. Since the Great Depression of the 1930s, housing prices had declined nationwide in only 3 years, and then only slightly. Real house prices had been reasonably stable, and because inflation offset the trend rise of nominal house prices, the spike in house prices in the years preceding the crisis was spectacularly unprecedented. See Figure 23.3. At the time, some argued that it was a bubble and therefore must burst and cause severe economic damage. Others said that housing fundamentals, growing household income, lower mortgage rates, and the like had boosted affordability, which both justified the price surge and made it sustainable. The ensuing collapse in home prices settled the debate, bringing on financial and economic contraction more severe and widespread than even most pessimists expected. Abrupt changes in asset prices, like the U.S. house price bubble, affect virtually every aspect of economic activity. Looking back at the first part of this chapter, we can see that changes in asset prices have a direct impact on both consumption and investment. Bubbles, which are identified after the fact by a sharp rise and then a sharp decline in prices, are damaging in part because the wealth effects they create cause consumption to surge and then contract just as rapidly. Equity bubbles, like the boom in the internet sector in the late 1990s, allow firms to finance new projects more easily, causing investment to boom and then bust. See Figure 23.4. Bubbles are particularly damaging when their collapse impairs the balance sheet of leveraged intermediaries, risking a deleveraged spiral. See Chapter 3, Lessons from the Crisis, Leverage, page 50. The Great Depression, Japan's experience in the 1990s, the global crisis of 2007 to 2009, and the subsequent euro area crises all exemplify this pattern. For example, the loss of capital in the financial system in 2007 to 2009 could have led to catastrophe without extraordinary government actions. In contrast, the collapse of the internet bubble of the late 1990s had a relatively minor impact because of intermediaries faced limited credit exposure and remained well capitalized. Okay, you're going to want to finish this reading on your own. After finishing that reading, there's an external page called Fed Prohibits Predatory Lending Practices. Then there's an external page called Deflationary Spirals. Lastly, there's flashcards to review. This concludes Objective 4, and this concludes Unit 7.